Doesn't that mean that the SVIX, which is a -1 times product, won't that be the best one? Well, now we're in a situation where the drawdown is so substantial that it's significantly cutting into the performance. Now, it's true that during stable markets, obviously the full -1 is going to do way better than the 0.5, but the reason that you would still not want to use the SVIX, even if you're tactically rotating, because remember I said we can apply a lot and we can reduce those drawdowns. But when you're dealing with SVIX, there is that fine line where some days you're going to be in short volatility. VIX futures are stable, it's in contango, market's totally calm, no reason in the world not to be short volatility, and then you wake up the next day and something terrible happened. Those are the days that are a real gut kick if you're holding something like SVIX. You can't see them coming. It's just all of a sudden, overnight, something changes, stocks crash 3 or 4%, SVIX crashes way more than that, and you kind of just walk into this wall. So again, it's about balancing those drawdowns. I've talked about this a lot, but the larger the drawdowns you take, the longer it takes afterwards to get back to break even. So if we're talking about SVXY at about 46%, it takes 86% after that to get back to break even. That'll take a while. But at 79% with the SVIX, it's going to take 383% to get back to break even. And again, no doubt at some point the S&P 500 is going to crash 40 or 50%. Something like the SVOL will be down 70 or 80%. SVXY will be down 80 or more. The SVIX will be in the 90s. So when you're talking about something with a 90% drawdown, which will happen at some point, being 900% away from breaking even just means that the risk-reward ratio is no longer good here. It doesn't just keep going upwards. You don't go 0.5 is worse than 1, and 1.5 is better than 1, and 2 times is better than 1.5. It doesn't keep going like that because at some point you're just walking into gut kicks. You can't avoid them all. Markets do crash out of nowhere sometimes. You don't want to be holding something that's 1 times leverage. You certainly don't want to be holding short volatility at 1.5 or 2 times leverage. And you absolutely don't want to be holding naked short options on short volatility. Those gut kicks, when you wake up and can't avoid it, those are the ones that blow up your trading account.